a low-risk investment product that's supposedly giving 6% plus returns. Is that a tad too suspicious? Now, the investment product I'm referring to is BigFundr, which recently gained some popularity perhaps to its ongoing double referral bonus program. On its website, BigFundr proclaims itself to be a leading investment platform that specializes in low-risk property loan deals. With deals offering 6% plus returns, it definitely caught my attention, and I thus decided to take a deeper look into BigFundr. So in this video, I'll be highlighting what BigFundr is all about, how the returns are generated, how safe are investors' funds with BigFundr, BigFundr's track record, and finding the risks associated with investing in BigFundr. So first up, what exactly is BigFundr all about? Put simply, BigFundr is a lending institution that provides property-backed loans to small and medium property developers. Now you might ask, why would these property developers not approach the bank directly for their loans, but instead go to BigFundr? Well, the short answer is, these small and medium property developers are deemed to be too credit risky from the perspective of banks. In the wake of the 2007-2008 financial crisis, a host of financial regulations has been imposed on banks when it comes to dispersing out property-related loans and credits. This is underpinned by what is known as the Basel framework. In short, banks have to consider the credit rating of the borrower's ability to repay, and also other factors like loan-to-value ratio and risk-weighted analysis calculations before dispersing any property-related loans. As most small and medium property developers will likely be non-rated, this naturally excludes them from the considerations of banks. Thus, this is where financial institutions like BigFundr step in to provide tailored services to these otherwise underbanked property developers. So now we roughly know how BigFundr operates. Let's look at how the returns are generated. In short, the 6% plus returns that investors receive from BigFundr actually comes from the interest that they charge on their property loans. In a video interview with Capital Investing, BigFundr CEO actually mentioned that their lend rate to property developers are about 10% plus. This means that the return that investors get is about 60% of the interest that is charged on the property loans. For these property deals, they're periodically released by BigFundr to its investors, and investors can choose to invest in them for as low as $1,000 for each deal. Such deals can range from structural additions or acquisitions of existing properties to wholesale constructions of new properties. Furthermore, such deals are also on a first-come, first-served basis, meaning to say that once they are fully funded, investors can no longer choose to invest in them. After funding property deals, investors will receive a monthly interest payment and also the initial investor capital at the end of a deal tenure. Now, the end of the deal tenure will likely coincide with the exit strategy of each property deal. Only for a relatively small amount of funds required, BigFundr most likely does not finance the full amount of the property loan. This is evidence for the latest property deal, where the proposed loan amount is significantly lesser than the total loan amount. So another interesting aspect to note is the wording that is used in the fact sheet of these property deals. As you can see from the latest property deal, BigFundr actually invests in the loan notes that are issued by the issuer. At best, this means that BigFundr co-investors is the issuer for the property loan, and at worst, BigFundr is just basically subscribing for that instrument of the issuer. Also, BigFundr actually has some stake in each property deal. Look at the recently concluded deal, you can see the proposed note amount is higher than the figure that listed when the offer is fully funded. Nevertheless, it will be good for BigFundr to actually include this detail in their website, so at least it provides some clarity to prospective investors. Once the deal has been fully funded, BigFundr will then transfer investors' money to its trustee after hedging it.
Yeah, so when you invest in a deal, right, so what happens is, the money is obviously all consolidated, right? And before it goes out, this is verified by Vistra, who are our cash managers. Again, for monies to move, it needs two keys, right? Our cash manager and ourselves, so it's always safe. So money goes to Australia, but before it goes there, it's hedged, right? So we hedge the currency, it goes to Australia, and it is held by the trustees in Australia. So monies that are invested in any deal are never ever released to the developer, right? Even though we say we lend to the developer, but the money is always held by the trustee, right? And then at certain points in the project, then the monies are released. So for example, if it was a residential development, after they complete the piling, for example, right, the quantity surveyor verifies that the work has been properly done, and they release that amount of money to the piling contractor. And then when the next stage of development is completed, say for example, the superstructure is done, right? The quantity surveyor again verifies that, and then the amount of money is released to the contractor. So it's only right at the last stage where developer is due his profit does the amount of money get released to the developer.
So now we know how BigFundr generates returns for its investors. Let's now look at how safe investor funds are with them. Firstly, BigFundr is an MAS regulated entity with a capital services market license. This means that it is screened by MAS to be a proper company at the point of license application. Additionally, in terms of investors' money with BigFundr, they are held separately with the trustee. Thus, in the unfortunate event that BigFundr goes bankrupt, investors' money will still be safe with the trustee, although the funds will not be accessible until legal proceedings or acquisition by third party are completed. Nonetheless, this does not mean that investors' funds with BigFundr are capital guaranteed. There could still be losses arising from investing in BigFundr's investment products. This is where it's so crucial to look into how BigFundr actually protect investors' funds from potential losses. To protect investors' funds from potential losses, BigFundr has in place what it terms as 3 layers of protection. The first layer of protection is the first legal charge on the property. In the event of borrower default, the underlying property will be sold, and BigFundr as fund managers have first dibs on the sales proceeds of the property. The second layer of protection is that each loan is guaranteed by the borrower. This means that in the event of a default, BigFundr can seek legal recourse should there be any potential shortfall in the loan amount after liquidation of property. So the third and final layer of protection is what is called a buyback provision. According to BigFundr, it has in place agreements with bigger fund managers for them to buy back a loan should a need arises. According to BigFundr, these fund managers all have assets under management of more than $1 billion AUD, which means that exposure to BigFundr's loans are actually considered to be rather minuscule. So in addition to these 3 layers of protection, BigFundr also has a 12-month contingency period to fix any repayment issues. Also, during this period, investors will receive an extra 1% interest per year. To conclude the protection for potential losses, BigFundr also mentioned that each property deal goes through rigorous background checks, and the maximum loan-to-value ratio for its loans will be capped at 70%. The remaining 30% of property value will be equity for the borrower. So while it's good to have safeguards for potential losses in place, it's also important for investors to assess the track record of BigFundr itself. According to its website, BigFundr states that 0% default rate on its loans since 2021. However, if you look at the footnotes, it states that this default rate only accounts for loans that are disbursed within the years and exclude loans that are previously disbursed in previous years but defaulted in subsequent years. If you ask me, I think the definition of default rate is rather misleading and does not show the true picture of how well BigFundr's investments are faring. So besides considering the track record of BigFundr, I also decided to look into BigFundr's management team for their expertise with regards to the real estate sector. After all, this has a direct impact on our assessment of future property deals. Of the entire executive team of BigFundr, only the CEO has experience in the real estate sector. Looking at the CEO's LinkedIn profile, we can see that he has experience working as an asset manager and managing director at previous real estate companies. Now, whether this has any impact on investing performance remains to be seen. At the very least, the CEO has experience in doing risk assessment and evaluation of BigFundr's future property deals. All that said so far, let's now look at the risks that are involved with investing in BigFundr. So I think the risks that is involved with BigFundr can be categorized into 4 sections. Number 1, borrower default. Number 2, property attractiveness. Number 3, property market trend. And finally, number 4, counterparty risks. So starting with borrower default, due to the structure of BigFundr's property deals, investors are ultimately providing debt to property developers. Thus, the biggest risk will inevitably be the financial health of these borrowers. So while BigFundr has in place a 3 years of protection, but the contingency period, they still need to think about the amount of legal costs and the amount of time that investors' funds remain stuck or locked up in each property deal should default occur. This will result in opportunity loss to investors as their funds could have been invested in other instruments that can provide higher returns over the long run. Furthermore, in times of financial crisis, the outright sale of underlying property may not be enough to cover for a loan amount due to depressed valuations. Now, additionally, Eagle-eyed investors will notice the subtle similarities of BigFundr with mortgage-backed securities in the past. Now, during the video interview, BigFundr's CEO was quick to distance himself from mortgage-backed securities.
So what happened back in 2007, 2008 was the great financial crisis. This was caused by the Lehman Brothers and the other banks packaging loans into investments. So is BigFundr sort of similar to that?
No, not at all. Actually, very, very different. So when we talk about packaging loans into investment, for us, every deal that we put on the platform, every investor can see what they're investing into, which development it is. So it's very, very clear. There's no commingling of risks, in that sense. It's a clear investment into a specific loan, right? So I don't think we are anywhere near that sort of commingling of good loans with bad loans, etc. at all.
So now, despite the CEO comments, prior to the 2007-2008 financial crisis, mortgage-backed securities also deemed as safe investments, as the thinking was that a full mortgage default would not occur. Well, that worked pretty well until financial institutions decided to grant mortgages to credit risky clients, as well as the subsequent collapse of the property market. Thus, besides the risk of borrower default, there's also a need to look into the attractiveness of BigFundr's properties. So given that BigFundr's exit strategy for most of its deals are either through a full sale of its borrower's properties or through refinance, the quality of properties is thus inherently important. Should there be less or poor demand for borrower's properties, it becomes much harder for BigFundr to exit these property deals and return investors' funds at the end of a deal tenure. So what BigFundr does not display the locations of the property in each of its deals, they do provide some images in the funding phase. Looking at the latest concluded Collingwood deal, we see the property looks like a small suburban building. Now if you ask me, suburban buildings can be a hit or miss at times. This is because listing interests will be dependent on local businesses in either the town or the suburbs. They also lack the traditional pool of bigger commercial or residential properties. Thus, what BigFundr CEO states that they are keen to actually land on residential properties.
Us, we are keen to land on residential developments. And residential developments because it's driven by real demand, right? So there's a lot of immigration and there's demand for residential properties, right? So we are keen to land on that, but also we are only keen to land on projects which are generally within the medium to affordable range or in the market, right? So we typically don't land on ultra luxury developments. We like to land on developments which are more bite-sized, right? So we prefer to land in the key cities, etc. So these are places which we feel like the demand is stronger. Also look at industrial, but again, there may need to be a certain level of pre-sales or pre-lets. So how we analyze developments is really, it depends on a variety of factors, right? It can be based on pre-lets, pre-sales, they may have a refinance in place already subject to achieving certain targets, for example, right? So those are the projects we prefer to land on.
There is no guarantee that such properties are able to be successfully listed out and thus fulfills BigFundr's exit strategy on them. So besides borrower default and property risk, investors also have to consider the general trend of the property market. Currently, most, if not all, BigFundr's deals are in Australia. Hence, I'll be using Australia's housing property market trend as a reference. Looking at housing loan commitments in Australia, it does paint a rather rosy picture. The amount of new loan commitments has been on steady incline, be it for owner-occupied or investor residential properties. This indicates that the housing market continues to be seeing strong demand. Residential vacancy rates also remain at slightly low levels, although it risen slightly in 2024. This indicates that there continues to be leasing demands in the Australian market. This should bode well for BigFundr's residential property deals should they remain in the Australian market. Nevertheless, while the Australian market seems to be healthy, we don't know how long this may last. Also, it may be prudent for investors to actually assess the property market based on cities instead, as it might tell a different story and have a more direct impact to BigFundr's individual respective property deals. In addition, should BigFundr expand and pursue other property markets in other countries, investors will then have to do their homework on the intricacies of each of these property markets. Now, for the fourth part of counterparty risk, remember how I mentioned that BigFundr investors in loan notes earlier in the video? This brings about another layer of risk to investors. What happens if the fund managers that are supposedly a third layer of protection are the ones that face financial difficulties? Would BigFundr be able to fully redeem its loan notes that is purchased on the issuer? So what is loan notes are actually secured with an interest in the first mortgage units? It's unclear how much of these units are BigFundr entitled to, given that they do not fund the entirety of the property loan. Hence, given that this relation or agreement of BigFundr with fund managers are not very clear on the website, prospective investors want to write in and inquire more about it before putting their funds with BigFundr. So after considering all aspects of BigFundr, from the way it generates returns to the risk that's involved investing in it, I do not find that 6% plus returns justify the risk that's involved. Not only does BigFundr's investors take on borrower and counterparty risks, they're also exposed to the up and downs of the property market. Furthermore, their funds are also locked up in such deals for at least 6 months or more. This could prove costly in a black swan event or a sudden downturn in the property market. Personally, I would invest in more liquid real estate investments like individual REITs or REIT ETFs. As a comparison, the Nikko AM Straits Trading ex-Japan REIT ETF has a yield of 5.84% as of 18 December 2024. Although lower than the 6% plus returns that BigFundr offer, investors can easily liquidate this ETF should need arises, and their risks are more diversified. And on the fact there is a prospect of capital appreciation too. Now, if you still want to invest into BigFundr, I would say do not put too much of funds into it and definitely find a referral code online. Also, it should really only be a consideration after allocating most of our funds to more liquid investments. Like all investments, due diligence will be conducted and definitely will not consider BigFundr to be a low-risk investment.